time to analyze this. The dollar slightly higher today after the better-than-expected jobs number, but the currency's weakness continued this week on QE2. Joining us now to analyze the direction of the dollar, author of How an Economy Grows and Why It Crashes, Euro Pacific Capital's Peter Schiff joins us on the Fast Line. Peter, always great to speak with you.
Yeah, well, QE2 is certainly going to weaken the dollar, but more importantly, it's going to weaken the U.S. economy. We can never have a recovery while the Fed is doing QE. Any jobs that are created or any economic growth that is generated by QE2 will evaporate as soon as they stop doing it. So when they stop, then we're going to be in worse shape than we were before they began, and now they're going to be forced to do QE3, and the more they do it, the bigger problem they end up creating. The best way to allow the economy to recover is for the Fed and the government to get out of the way and let the market function.
First of all, Peter, I like a man who's got a lot to talk about, starts right out of the gates with what he wants to say. Got to commend you for that. But I do want to ask you about today's jobs report. I mean, doesn't it show that perhaps there is life in this economy and that this, QE2 could just be a stopgap measure until the economy actually improves? We're seeing signs of it.
Lost, we created the wrong kinds of jobs. We lost manufacturing jobs. We need to create manufacturing jobs. So the service sector jobs that we created are just going to result in a bigger trade deficit because we're creating consumers, but we're not creating producers. We are adding to our imbalances. If the government got out of the way, then we would be losing service sector jobs and creating manufacturing jobs. That would be progress. What we're doing now is digging ourselves into a deeper ditch.
But in terms of the stock market and the economy are different animals. The stock market's rising on QE2, rising even on the possibility of QE3 because the dollar's going to weaken. And right now there's a very strong inverse correlation between the dollar and stocks. So if you think the dollar's going to go down more, that doesn't necessarily spell trouble for the stock market.
But it doesn't make you richer. You see, when the government does QE2, everything goes up. It's not just stocks that are going up. Oil's going up, food's going up, gold's going up. The dollar is losing value. So even as the stock market has a higher dollar value, people that own stocks aren't any richer because when they sell those stocks or they cash in their dividends, then they go and buy food or buy gasoline. It's going to be more expensive. So it's all an illusion created by the Fed.
Hey, Peter, based on this illusion, what is the best area right now that you like? Do you still like gold? Is that the best opportunity, or is it silver? Is it copper? Or what is it?
Absolutely. My silver stocks that I own, I've never seen rises like this. Some of my two biggest personal stocks right now are both silver stocks. They've gone ballistic. The gold stocks, in fact, I think if you look at the gold stocks, I think what's happened this time, normally for the last several years of this bull market, the metal was leading the stocks. Now the stocks appear to be leading the metal. I think that's a very healthy sign that we are going into another leg of this bull market where you're going to see much bigger returns on gold mining stocks and a more steady upward move in the price of gold. So I think that's a very good sign that we have now for people who are buying gold stocks. It's not a good sign for American economy. It's not a good sign for people who have savings, people who have uni bonds or treasury bonds, people who are retired, because it means that the cost of living is going to go substantially higher and Americans are going to see a big drop in their standard of living.
All right, Peter, got to leave it there. Thanks so much for joining us, Peter Schiff of Euro Pacific Capital. And in fact, take a look at this chart. This is a 3-month chart showing the GLD, which is the gold ETF, the gold miners, and then the junior miners. Pete, you're noticing this today, but certainly outperformance by the junior miners, and then the miners, and then gold. You think gold is a meteoric rise? Look at the miners.
You want performance in this market, you want beta, and that's why I think you target something like the GDXJ.
Okay, we got to take a break. Coming up, we are all over the market today. We're breaking down tech's big move. Much more halftime reports straight ahead.